Investing is a journey to build wealth, often achieved through regular contributions. Experts emphasize the potential of consistent investing, turning everyday individuals into prosperous ones over time. Trying to time the market can be time-consuming and might not yield the best results. Many investors, perhaps without realizing it, are following a strategy known as dollar-cost averaging, which has its advantages. Why should we invest gradually in small amounts, but not all into the stock market at once? In economic downturns, like the current situation, should we hold on to our cash and wait for the market changes to strategically time our investments for better profits? Understanding dollar-cost averaging is key to navigating these decisions and unlocking its potential benefits for investors. In this video, we will explain what dollar-cost averaging is, why the strategy works, and how you can implement this strategy. Dollar-cost averaging is a straightforward investment strategy that you are regularly investing a set amount of money into stocks or funds. This could be weekly, bi-weekly, monthly, or quarterly. Your money gets automatically invested in a chosen stock or fund, no matter the market goes up or down. For example, you are setting aside $100 every week to invest in a stock. In week 1, the stock is $100 per share, so you own a share of stock. In week 2, the stock drops down to $80 per share. Then you own 1.25 shares of the stock. In week 3, the stock goes down to $70 per share. Then you own 1.43 shares of the stock. In week 4, the stock goes up to $110 per share. Then you own 0.91 share of the stock. Within a month, you own 4.59 shares. If you invested $400 only one time at the beginning of the month, you could only own 4 shares of the stocks. The extra 0.59 share of the stock may not seem too much for you, but it will make a big difference if you are consistently investing for decades. During a stock market crash, this strategy allows you to buy more shares with the same amount of money. Why is dollar-cost averaging the best strategy for many? According to Charlie Munger, most people believe they can beat the market and predict its ups and downs, but the reality is the opposite. When those catastrophic events happened, like the stock market crash in 1929, Pearl Harbor in 1941, Black Monday in 1987, dot-com bubble in 2000, and Lehman Brothers' bankruptcy in 2008, most people could not foresee these crises. Predicting such events is nearly impossible. Additionally, these events are the excuses for the stock market to crash, but not create crises. Every time that happens, it produces irreversible changes to the world. The world is fragile, so is the stock market. In the long run, the stock market is going up, but every time a crisis happens, the stock market tanks quite a lot. From another perspective, we can say the stock market is at a discount. Since predicting the market is tough, then there is no perfect time to invest. Dollar-cost averaging is likely the best method for average people to invest. There are 3 good reasons why the dollar-cost averaging works well for most people. Number 1, it is easy to achieve. Constantly investing in a stock or fund does not require any financial knowledge. Other methods like day trading and options are all required to know different concepts to execute. Even if you understand them, you are still likely to lose money. The stock market is not rocket science. There are so many factors that can immediately affect the stock price movement. With dollar-cost averaging, anyone, whether you are a student, a stay-at-home mom, a janitor, or a retiree, can easily reduce risk and make profits in the long run. The only requirement is to have a brokerage account. We all can do it. Let's say you started purchasing S&P 500 at the end of 2021, which is the highest point in history. By executing dollar-cost averaging, your investment will probably have a positive return at the moment. On the contrary, if you made a one-time purchase of S&P 500 at the end of 2021, your investment could be negative today. Number 2, dollar-cost averaging prevents us from trading emotionally. Most of us are regular people, so having greed and fear is normal. In the stock market, emotion can greatly influence our decisions. Some believe they can buy low and sell high. In reality, this is very hard to achieve. On Black Friday, many are excited about discounted products and purchase them without hesitation. Ironically, Most people start panicking and selling shares as fast as possible when they see the stock price drop. That is fear. As the market rises, greed kicks in, leading people to buy more shares. Your emotion may lead you in the wrong direction. By implementing dollar-cost averaging, we can effectively avoid buying high and selling low. Just like a robot, constantly buying in for a long period of time will get you the best results. Number 3. Dollar-cost averaging puts your money to work for you. When you leave your money in the bank, all you receive is a small interest that won't grow much over time. Instead of waiting for the best possible time to invest, all your investment is continuously growing in the stock market. This means your money is always working for you, earning dividends and compounding over time. The best thing is that the money will grow automatically and allows you to focus on what matters the most to you. How do we implement dollar-cost averaging? First, we need to open a brokerage account. This account could be from Vanguard, Fidelity, or Charles Schwab. Also, you can choose between personal investment or retirement accounts like IRA, 401k, or both. Second, figure out the funds that you would like to invest in for the long term based on your current financial situation. If your income is limited, start with 1 or 2 index funds. Later on, diversify the portfolio as your financial situation improves. The S&P 500 is the most popular index fund to invest in. This is the benchmark of the U.S. stock market. The average return is about 10% per year in the past 30 years. You can purchase FXAIX, offered by Fidelity, or VOO, offered by Vanguard. For tech enthusiasts, consider investing in QQQ, an index fund that tracks NASDAQ composition offered by Invesco. FNCMX is an alternate option offered by Fidelity. There are mid-cap and small-caps index funds out there, like IVOG, MDYG, VSIAX, and FZIPX. These index funds have much higher volatility than S&P 500. If you are about to retire and would like to have steady cash flow, you can consider investing in high dividend yield ETFs like SCHD and VYM. Make sure to do your own research for the funds that fit your unique situation. Generally speaking, if you are okay with average returns, just go with the popular funds out there tracking S&P 500, NASDAQ, or any large-cap growth funds. The key is to consistently invest in the fund for a long time. Last but not least, set up the frequency and amount you would like to invest on the brokerage account. You may increase the contribution as your income grows. Now, you can sit back and see your money grow. This process is very boring, but it is the most effective way for regular people to invest. Constantly investing small amounts of money over an extended period can effectively lower the risk and maximize profit. Timing the market is tough, even for experts. That's why using this proven strategy makes sense for everyday people like you and me. Don't be tricked into thinking that you can buy at the lowest point and sell at the highest point. Instead, keep investing the same amount regularly and increase the contribution when your financial situation gets better. You will get more shares when prices are low and fewer when they are high. Lots of people have succeeded with this method, and you can too. If you found this video insightful, please hit the like button and subscribe for more content. See you next time.